This is Optimal Finance Daily, episode 1978. Stocks, Part 15, Target Retirement Funds, the simplest path to wealth of all, by J.L. Collins of jlcollinsnh.com. And I'm your host and personal finance enthusiast, Diana Merriam. Now let's get right to today's post as we optimize your life. Stocks, Part 15, Target Retirement Funds, the simplest path to wealth of all, by J.L. Collins of jlcollinsnh.com. Okay, so you've read The Smoother Path to Wealth and thought, oh man, 3 funds and I gotta rebalance them every year. That's too much to keep track of. But then you hit the link and went to The Simple Path to Wealth. As you read, you thought, this is more like it. Only 1 fund. This I can handle. But then you got to the part where maybe 40 years from now, as you start looking at retirement, you're going to want to add a couple more. Aw, man. J.L. Collins NH hears your pain. You need the simplest of all possible paths. You need to be able to buy just 1 fund and own it till your dying day. Any asset allocation should be handled for you. You have bridges to build, nations to run, great art to create, diseases to cure, businesses to build, beaches to sit on, motorbikes to ride. I'm here for you, Bunky. More importantly, so is Vanguard with a series of 11 target date retirement funds. For that matter, so are other mutual fund companies. But as you know, Vanguard is the primo choice around these parts, so we'll be talking about these. If your 401k or similar plan offers only one of the others, what is said here, accepting expense ratio costs, applies. You would see that these 11 funds range from Target Retirement 2010 to Target Fund 2060. The idea is you simply pick the year you plan to retire, and that's your fund. Other than adding as much as you can to it over the years and arranging for withdrawal payments when the time comes, there's nothing else you ever need to do. It's a beautiful and elegant solution. Let's peek under the hood. Each of these target retirement funds is what is known as a fund of funds. That means that the fund holds several other funds, each with different investments. In the case of Vanguard, the funds held are all low-cost index funds. That's a very good thing. The target retirement funds ranging from 2020 to 2060 each hold only 3 funds: Total Stock Market Index Fund, Total Bond Market Index Fund, and Total International Stock Market Index Fund. To those 3, the Target Retirement 2015 Fund adds Inflation Protected Securities Fund. To those 4, the Target Retirement 2020 Fund adds Prime Money Market Fund. As the years roll by and the retirement date chosen approaches, the funds will automatically adjust the balance held, becoming steadily more conservative and safer over time. You needn't do a thing. The expense ratios range from 0.17 to 0.19 depending on the fund. Excellent. What are the shortcomings? Some people say the funds get too conservative too soon. Others complain that they're too aggressive for too long. For my money, I think Vanguard gets it pretty close to spot on. Maybe a bit conservative for me personally, but then I'm on the aggressive side. This is easy to adjust for. If you want a more conservative, greater percentage of bonds approach, choose a date before your actual retirement. The earlier the date, the more conservative the asset allocation. If you want more aggressive, greater percentage of stocks, just pick a later date. In deciding, be sure to remember what we learned looking at the Trinity study in our discussion of withdrawal rates. A strong dose of stocks is critical to a portfolio's survival rate, especially once you begin drawing money out. By the way, other fund companies use differing allocations for differing retirement dates. If those are what's offered in your 401k or 403b plan, you'll need to take a look and then decide. But the same principles apply. So why doesn't J.L. Collins NH recommend them? I do, actually, and am with this post. They're an excellent choice for many, maybe most people. They will certainly over time outperform the vast majority of active management investment strategies. but I do have a slight preference for the smoother path to wealth and the simple path to wealth. Here's why. The expense ratios are even lower than those of the target retirement funds. The target retirement funds all hold the International Stock Market Index Fund. While this is an excellent fund, I don't feel the need for additional international coverage beyond that found in the Total Stock Market Index Fund. And with separate funds, I can keep my bonds in my tax-advantaged accounts, protecting the interest from taxes. Where are you likely to find target retirement funds? Target retirement funds have become very popular as options in the 401k and 403b retirement plans offered by employers. The thinking is, and it's sound, that most people really have very little interest in investing. Target retirement funds provide an effective, simple, and well-balanced one-decision solution. Plus, because such retirement plans are tax-sheltered, the interest from the bonds and the dividends from the stocks go untaxed. Of course, when the funds are withdrawn in retirement, taxes will be due. What should you do? If your 401k or the like offers target retirement funds or low-cost equivalents from another fund company, they are well worth your consideration. If you want as simple as possible and still effective, target retirement funds are for you. You just listened to the post titled Stocks, Part 15, Target Retirement Funds, the Simplest Path to Wealth of All, by J.L. Collins of jlcollinsnh.com. If you'd like to hear the completely opposite advice from what you heard today, check out episode 1956, titled Why You Shouldn't Buy Target Date Funds by Wanderer of millennial-revolution.com. And while these two articles seem to contradict each other, I actually agree with both of them. While I personally don't invest in target date funds now, I do feel the offering could be a good solution for someone who's just starting out and nervous about investing. If the alternatives are to not invest at all, work with a financial advisor who is selling you expensive financial products you don't need, or leaving money on the table in the form of a 401k match because you're simply overwhelmed by which investments to choose from in your 401k options, a target date fund could be a good temporary solution. After you read J.L. Collins' book titled The Simple Path to Wealth and you get more comfortable and knowledgeable about investing, you can change your investment selection to something a little more optimal in terms of fees. I also wanted to point out that if you do decide to invest in a target date fund, please only do so in a tax-advantaged account, not in a regular after-tax brokerage account. Last year, we saw a situation where Vanguard reduced the minimum needed to invest in their institutional target date funds. And that announcement triggered a lot of people to jump from the higher cost retail fund to the lower cost institutional fund. Vanguard needed to sell fund assets to raise cash to redeem shares for investors in the retail fund, which resulted in capital gains that were 40 times larger than previous years. Tax-advantaged accounts are able to reinvest the gains without a tax bill. But if you were holding these target date funds in a taxable brokerage account, it would have resulted in an unexpectedly high tax bill in 2021. And that will do it for today. Have a great day and rest of your weekend. Thank you for listening, and I'll be back here in a moment with a bonus episode. So stay tuned for that, where your optimal life awaits.